Good afternoon and welcome to this panel on the second day of UK FinTech Week. My name is Mike Coombs and I work at PrimaryBid, a UK capital markets FinTech that's delighted to be sponsoring this year's proceedings and hosting this afternoon's panel. Yesterday, some of my colleagues talked about IPO innovations, and later this week we're hosting a panel on stakeholder capitalism. But today we're talking about financial market infrastructure, a topic which burst to the forefront of press commentary earlier this year during the so-called GameStop saga. It's not been a quiet year for anybody in the capital markets, but nevertheless for anyone involved in those markets, financing or investing, whether at a professional or a personal level, GameStop was extraordinary as a moment of public engagement. That's engagement with a wide range of issues, such as the way public stocks get traded, the way that certain businesses make money, and indeed the way that the pipes and the regulations are all configured in the background. So today, I'm delighted to be joined by a group of operators, investors, and advisors to talk about it. Tara Reeves is a partner at Omer's Ventures, whom I've had the privilege to know for several years as a fintech investor. Jason Naby is Group Head of Strategy and M&A at Euroclear, which for those who are unaware is an, if not the largest, international central securities depository at the very heart of our financial system. Duncan Leslie is a VP of Product at UK FinTech Free Trade, a fellow traveller alongside PrimaryBid in our mission to democratise access to the public equity markets, and with whom we share an investor. And finally, Andrew Stockdale, who's an Executive Director and FinTech Specialist at JP Morgan. So without further ado, over to my panelists. Jason, why don't we start with you? People have heard about the Reddit forum Wall Street Bets, and I'm sure people have read about the hedge funds being short squeezed by a retail trading army, some of them who use derivatives to drive the price upwards. But when the carpet was rolled back and people got a peek at the financial markets infrastructure underneath, what did they see?
So, hi everybody, thanks Mike. Obviously I can't comment on some of the specifics with regards to some of the players, and I think the whole GameStop saga, the short squeeze, for a few at least, was a somewhat convenient reminder that the underlying plumbing of financial markets, capital markets, is built in a certain way with certain capabilities and certain control measures. So, what I think became apparent, and I think there were also a few hedge funds on the short squeeze, as well as a mass of retail investors. But what became apparent is the 2-day lag between purchase order and settlement obviously created somewhat of an issue specifically for platforms like Robinhood when it comes to funding collateral or margin calls specifically. And in that context, I think again, this debate that isn't new came back to the fore, which is, is there a better way of technology playing a part in more real-time settlement or same-day settlement? So again, just for full disclosure, I used to work for a firm called Paxos. And Paxos is one of those sort of blockchain, maybe more disruptor type initiatives that's out there, and specifically looking to establish a US pilot for same-day settlement with a number of actors in the marketplace. But I think that aside, I think GameStop was somewhat extraordinary for the reasons we've touched on. But what you'll see across the FMI, the financial market infrastructure space, are an awful lot of well-run, well-organized, well-resourced businesses that are dedicated to the resilient, stable operations of the capital market ecosystem. And, they've been at the forefront of much of the innovation and much of the transformation that's going on. And I'll pick some examples other than Euroclear, just to perhaps elaborate the breadth and depth of this. And, ASX were primarily one of the forerunners, first movers in declaring the plan and their program to replace their legacy infrastructure for equities post-trade with DLT working with digital asset. And I think you've had Yuval from digital asset on in the conference already. And others, the SIS X out of Switzerland have launched a new, entity focused purely on digital assets. And there are many across the industry, Deutsche Börse Group, collaborating in much the same way as we are at Euroclear with emerging fintechs and platforms in the context to look at how some of this new technology can continue to help evolve and deliver efficiencies across the industry. But I think, look, GameStop was a timely, if not convenient, reminder of the fact that the US market at least is a 2-day settlement process, and consequently, firms have to operate within the current constructs and the current conditions, and there's no surprise there. I think there's a little bit of backstory to Robinhood and some of the actors involved, which I won't comment on, but I think there's certainly a lot at play. And I'd just perhaps close maybe the opening comments to highlight again, I think this is a significant opportunity for fintechs to collaborate with the FMIs, and vice versa, for the FMIs to go out there and partner with incredible fintechs that are helping reshape the capital markets landscape. And it's a journey. This isn't going to happen quickly. It's, we're arguably 5 or 6 years into the cycle, and it's, by my guesstimates at least, a 10 to 15 year cycle in terms of how we transform and develop and transition to some of these newer technologies. But it's all work in progress.
And Jason, just if you can give us 10 seconds, that was a hugely helpful introduction, but just 10 seconds. When I send money from one bank account to another, it just moves. Why are stocks different?
It's a good question. Clearly the way the markets operate today, and there's some perhaps nuances. I'm going to try and keep this to 10 seconds, market by market. But you've got various actors with various permissions and licenses and capabilities and balance sheets considerations. So whether it's a venue, a platform like a Robinhood that effectively is an aggregator of order flow, and then you've got executing brokers, you've got obviously clearinghouses, and then you've got underlying custodians and settlement agents, and then you've got again underlying securities depositories like Euroclear and the DTCC, effectively running the book of records and the final settlements capabilities. And then that's just the security side of things. Then you've got all of the payment wires and all the payment processes attached around that. Because again, there's always the movement of cash or credit versus securities. But I think this has been designed over many years for many good reasons. And I often get asked this question as to why is it so complicated? Why is it so complex? I think it's been designed for good reason, to protect the interest and to manage the business of securities and payments. And there's no big bang events. We're not going to see a big bang all of a sudden. Everybody migrates to a new wonderful DLT-enabled platform. This is going to be a series of events over quite a period of time.
Thanks for that. A little longer than 10 seconds, but I think it's a great segue to Tara, if I can bring you in, Tara from OMERS. Last year, you published a long piece on the future of the capital markets tech stack, touching on a number of these complex areas that Jason's mentioning, and if I remember correctly, it included some startup ideas for budding entrepreneurs, including a neo-clearer for Europe and a neo-prime brokerage. I suppose looking back, writing that in November of last year, did you have any idea that the capital markets tech stack was suddenly going to burst into public interest?
I wish I could say yes, but really not. What had happened though is that I'd begun talking to some bankers as I had been a seed investor. We never talked to bankers at all. And then when I joined OMERS as a Series A and B investor, and some later stage, I got to meet people like Andrew, who are bankers, and I was seeing this kind of really weird dichotomy where you had sort of one half of people dealing with capital markets, sort of hedge fund traders and people who were sort of trading on bare metal and squeezing out every single second of additional advantage, who were super technical, who were constantly thinking about kind of the speed of their infrastructure and how to squeeze out like a tiny advantage. And then you're talking to this other group of people who were just sort of, using Excel maybe, but who still had these enormous notionals, and sort of as from an outsider's point of view, I was like, this is bananas. I've been a fintech investor for years, but primarily in consumer and SME fintech. But again, when I look at the notionals and the size of the capital markets pool, it was just so vast compared to what I was looking at that I got incredibly excited. And I was like, right, this is where I want to spend some time, leading, of course, investment in primary bid, which I'm very excited about. But just, yeah, it's just so weird, right? So kind of Andrew, right? You're a banker. How is it that some bits of capital markets are so technical and some really are not?
Yeah, it's a great question. I smiled when you mentioned kind of Excel, because I feel like that is a very large part of our world still. And you're right, there's kind of parts of capital markets that have been on this journey of kind of, developments and really technology coming into them in a big way. If you think about the kind of electronification of trading in many asset classes that's happened over a very long period of time. And then there's, a lot of what we do as investment bankers, the part of capital markets that we touch. So, the IPO process, even things like corporate bond issuance, it's still very antiquated in terms of how it works. And, I do think there is a recognition, at least in our organization, and I think in terms of the entire ecosystem, to be honest, that actually this needs to change. And I think fintechs have a massive role to play in actually driving some of that change. So I think it's quite exciting what is beginning to happen in some of the capital markets that we deal in terms of developing this.
And Andrew, if I can just, now that I've got you've got this very enviable perch in a universal bank that's a key part of what we might call that traditional and perhaps centralized market infrastructure. I'm sure JP Morgan is on the side of many trades and many deals, etc. But your job day to day is advising companies, particularly within asset management and fintech. And how are they thinking about, or have they started to have a different conversation about what they might be able to do in terms of vertical integration? Or in other industries, we'd see people, when they perhaps have issues in the supply chain, they might look to go and control more of it, to understand more of it, and put their destiny into their own hands. Can this happen in this kind of market infrastructure, or is it too highly guarded and too highly regulated and centralized?
No, it's a great question. And I think actually to what I was just saying, I think what's really changed in the last 12 months, 18 months, 2 years, is actually I think there is a much broader recognition from the whole ecosystem that change is coming and we should be part of that. So, whether it's regulators looking at how an IPO process works, like the Lord Hill reviews here in the UK, whether it's, technology companies pushing banks to do things in a different way, like Spotify in the US with direct listings, and people now thinking, can we use direct listings to raise capital and change how that whole process works? There's a momentum behind change, I think, and I think we all recognize we need to be part of that, otherwise we'll get left behind. So I think from where we sit, we don't see the people like Primary Bid, for example, as a threat. We see them as quite complementary to what we do, which is offering a great service to our clients. And if we can bring more retail investors in a technologically enabled way, that's a good thing. So I think from where we sit, I see kind of a big desire, I think, to be forward thinking and to partner with fintechs. And maybe at some point we may make investments in some of these fintechs as well. Like, Jason and Euroclear is a great example of, I can't remember when it was, but, a consortium of banks invested behind Euroclear to really help drive that. You may start to see some of that happening as well.
Mm. And Duncan, I've got to bring you in here as someone who's building a stockbroker from the ground up, a stockbroker with community and conversation perhaps at its heart, which were kind of central to that GameStop story. I guess, as you're thinking about product roadmap, features, etc., how do you go about that? How are you thinking about your new tech stack?
Yeah, I mean, thanks for having me. Firstly, it's an interesting challenge. It's an interesting time for investing, but I think in many ways it's a continual evolution over time. It's not something that's happened that's completely different. Now we've seen these catalysts over the years of events that cause a growth in retail investment, and I think for a number of years we've all said that retail participation is something that we should be promoting and encouraging. And I've worked in retail investment myself for my entire career, and it's always been something where we've said, people should be investing, subject to all the compliance risk warnings, etc. It's a good thing to be investing, taking more control of your finances. And yet we know that it's not always been the most accessible thing to everybody. And that's really the challenge we see. So, you've got things like high commissions or custody fees that's really eating away into the amount that certain groups of people have available to invest. And so fundamentally, it's a barrier. We speak to thousands of people who have said to us over the years that we've been in existence that they know they want to invest. They know they should be investing. They know they should be taking their finances seriously and taking control of it. But it hasn't always been something that they can do, because if you're investing, say, £200 and 10, 15 of that's going to go on commission, then all of a sudden you're starting in a very negative position. It's not always the same as someone who's sticking in, say, 2,000 in an investment. So we really set up Free Trade to challenge that and challenge the status quo, really aiming to make investing open to anybody. And that's a really tricky challenge. So to your point about, or your question around, how do we think about the roadmap? How do we think about the features? I think there's probably a common misconception that the retail investor that's not investing a significant amount might be, maybe the young audience is more looking at speculation. That is absolutely not what we see at all. We're seeing people who are well informed, very willing to do their research, looking to build what might start as a small portfolio, but for the long term, for long-term growth. So they are a similar demographic in terms of investment strategy to any other retail investor, but not necessarily that well supported. So the challenge we have is, how do we tackle that? And obviously what we've done is introduce commission-free investing to try and take away some of those barriers that would otherwise stop people investing. But that by definition has been validated by the strong growth we've seen. A lot of retail investors that wouldn't otherwise have been investing are now doing so. And that's something we're really proud of and very happy to support and grow. But it's leading to a much higher volume of lower average value trades coming through the market. And that's when we get back around to, I think, this question of, is the infrastructure set up to support it? And I think, we've seen, as I say, a number of events, not just earlier this year, that have caused that to come under some pressure. And I think it's great that we're having this conversation to see it evolve. I think it's a really important topic at a really important time. The biggest challenge for us, though, is if we as an industry truly stand behind retail participation being a good thing that we should be promoting and encouraging and helping people to take control of their finances, then allowing people to invest commission-free is an important step towards that. How do those business models evolve through all the participants in market infrastructure so that model actually works? Because traditionally,
because you're not allowed to charge for order flow in the UK. That's correct?
That's right.
So you've got to, yeah.
I mean, we're not allowed to. We also wouldn't want to. We don't think it's the right thing for customers to get good outcomes. So we try to be entirely transparent with how any fees that we do charge for additional features, for example, but absolutely not payment for order flow.
Yeah. I suppose I'm just struck by the fact that what this whole saga revealed was people can believe in stocks, and a public stock, if you will, is a piece of infrastructure. It's a claim on earnings, both present and future, and it's accompanied by voting rights typically, and the public markets then value those claims and they go up or down. But it's the way that those claims then get moved, assigned, measured, etc., which is what we're really trying to get better at, and where there have to be more, I suppose, hopefully fintech solutions at them. I wanted to come back to something Jason said earlier about DeFi or distributed work, because I know proponents of blockchain argue that this is the perfect kind of technology to allow for tracking who owns what. Is that something that you've looked at all, Duncan, or maybe we take Duncan and then Tara and then back round?
It's something that we are keeping our ear to the ground on very closely. I think fundamentally, for the growth that I spoke about before, what we need to look at is how we increase efficiency throughout the model. And so I think Jason touched upon the T+2 settlement time that currently is common in the US, certainly, and is similar in UK and Europe, and potentially more than 2. Is that the most efficient system that we can have? I'm sure there's reasons why it exists, and I'm sure there's a lot of innovation going on to change it. So it's something that we will explore very closely with our partners as it becomes more common and more prevalent. And it's great to see that innovation happening in the market.
Tara, can I turn to you, just as the drilling work started outside my window?
Quite right. So I am actually not sure, Mike, that this is in fact the best possible use case for DeFi blockchain, because shares are basically sufficiently tracked and sufficiently fungible and sufficiently divisible that now, particularly with partial trading, that a lot of the problems around liquidity, around traceability, around valuation tracking have been solved, right? I am much more excited for blockchain in industries where those kind of really core problems haven't been solved. Things like collectibles, things like hard assets, things that aren't already kind of infinitely tradable very quickly. And don't get me wrong, I can see how there's an interesting use case to buy a share, but it's kind of way harder to buy a diamond or a fraction of a diamond. And so I kind of philosophically, I wonder why blockchain is trying to solve a problem that is more or less solved instead of tackling something a lot trickier and to me more interesting.
There are some asset classes that are already fractionalized, and stocks is one of them, and then there are some which aren't, like most of them.
So exactly. So why is blockchain trying to solve the stock issue? When, from my view, the stock issue has a lot of the issues around there have been solved, although obviously T0 settlement would be great. Looking at you, Jason, and how that gets sorted out.
Yeah, it's a good point. So, clearly one of the potential advantages to DLT and blockchain, I think, is a combination of different technologies. But if you look at DLT or running a distributed ledger, and it's proven, it's established already, but it's still being developed and adopted, is that you can create what we refer to in the industry as the atomic settlement, so an immediate settlement event. Now, in securities, that doesn't quite always work. So there's lots of refinement and development and piloting of the technology to look at how you could create slices of settlement through the day, and almost an intraday series of settlement events, which, again, may solve part of the problem, but you always then start to create different challenges. I actually think, I don't think that's the be all and end all when it comes to things like GameStop, and certainly I'm not an expert. I might come back to Duncan in a second, but I think DeFi and I don't mean to be disrespectful in this context, because I'm a user as well of these platforms, is the gaming of the gamification of investing. And because GameStop wasn't about a long-term investment play; it was about making a play against a bunch of hedge funds in a short squeeze. So, there was no interest in the voting or, any dividend off the back of that. It was just a bit of a punt. So what we saw is an incredible spike of volumes that ultimately created an issue for Robinhood, the platform, which, as you know, Duncan, does benefit from, going via a clearing member that pays for the order flow. So actually, it wasn't it wasn't really Robinhood's problem, although it became their problem. It was the clearing members' issue to deal with the DTCC. But that's just the mechanics of how the market infrastructure works today. But to go back to your point, blockchain does solve for parts of that, not all of that. But I think we've got gaming of investing, and I think we've got blockchain, which is an evolving technology. But I think the point around DeFi is an interesting one, but it's more of an umbrella movement, as we know. So I think we're going to see much more democratization of both retail and capital markets as technology and our usage of technology and our behaviors becomes much more digital, much more networked, much more supported through some of the various platforms and the things that are happening. And I think we're going to see a major crossover of crypto assets and securities assets, and the markets are going to be much more commingled than they have been in the past potentially. Which again, I think draws back to the GameStop example, where you had retail investors up against significant hedge funds. I think that crossover is probably going to become more and more apparent, and especially with, as I say, things like crypto assets becoming more mainstream.
Duncan, Andy, I want to give you a chance to respond to that, and then maybe in our final minutes we'll move on to one other thing. Do either of you have anything on that?
Yeah. So, firstly, I think you're absolutely right. I think for us, it is about building an investment platform. It's not about gamifying. And how we do that and how we would like to challenge that is through education. We are setting up the right business that will educate customers in how to make good choices. We don't offer leverage products. We're not allowing people to trade on margin. It's about having the cash in your account, which you can invest into instruments, and giving you the education to make better choices about what those instruments are. So I think that's really core to what we do. And I think you're absolutely right that that's a challenge for the market to make sure that it's doing these things for the right reasons, and regulation is there to ensure that you're thinking of how you deliver the right customer outcomes. And it's something that we hold very dear to our heart. It's really, we are trying to build trust with our customers, and we only do that by thinking of their long term, not the next couple of days, couple of weeks. I think just going back to the blockchain question, I think one of the important things for me is, this is me speaking as a product person fundamentally, but it's to focus on the problem that we're trying to solve, not the technology that we think might solve it. And that would be the thing that I would keep close the whole way through this. What is the problems that we think that we're trying to solve? Is it T+2? Is it something else? And if blockchain fits that, great, maybe that's the way forward, but maybe there's other technology that hasn't been discovered yet or is doing something different that could also solve that problem. So I wouldn't get too hung up on just what the technology is, but make sure we're keeping track of what problems we're actually trying to solve in the first place.
Yeah, Andy, I feel like working at a big bank, you must have a view on blockchain, given Coinbase's IPO this week, which suddenly catapulted it into the ranks of the largest or sort of the largest by market capitalization financial institutions, and I sometimes wonder how the banks got overtaken on this.
Yeah, it's a good question. I think it's safe to say there's been some skepticism across kind of blockchain and cryptocurrencies. I think in particular that's been fairly prevalent in our industry. We did do that IPO in the US, so I think we're still we're still involved. I think it's safe to say. And look, I think people have kind of come full circle, I suspect, on the whole technology and asset class, having had the kind of the boom a few years ago through to now. I think it feels far more real this time around and far more institutionalized. And the Coinbase IPO and the valuation they achieved is evidence of that for sure. I've got no doubt these things are going to continue to be volatile. You've seen, I think, a pretty large decline at the start of this week in some of the asset prices and the share price of Coinbase as a result. But it does feel like it's slightly more here for the long term this time around. I think what just to pick up on something Duncan was saying there about kind of education being key. I think for me that if you're talking about kind of bringing retail investors into capital markets in a bigger way, it has to be fundamental. And I think kind of related to that, what I'd really love to see is actually kind of some of the information disparities between institutional investors and retail investors be addressed, because I must admit I find it slightly suboptimal when we do an IPO process, for instance, and a retail investor at the end of it gets the 300-page prospectus of legalese and doesn't get the kind of shiny set of slides that we've put together for institutional investors, just as an example of that. And I think there's kind of a long way to go in terms of, fintechs developing, maybe fintechs and maybe others, but people developing kind of access to information, access to research, access to market data in the way that I get sitting in my seat, that a retail investor might need. And that goes kind of hand in hand with the education that I think is needed to really make a success of retail participation.
Yeah, look, I think that's a fascinating point. And one of the things that struck me back in January, February, when we were talking about GameStop, was the quality of at least some of the content on the Reddit forums like Wall Street Bets. These weren't, I think maybe Jason, earlier you suggested that these were people just having a punt, and I'm sure that does apply to an awful lot of them. But some of them, there was a meticulous piece of special situations analysis that wouldn't have been amiss on the trading floor of one of the big banks, looking at the positioning of the hedge funds, the structure of the options contracts, etc., and then thinking about what could be done around that, which I think is quite powerful. I suppose just as the investment world is flattening and you have things like commission-free trading and potentially more access to information, one of the things I'm trying to work out is, will that drive people to invest more in single stocks, companies that they love? And Duncan, correct me if I'm wrong, but I think part of free trade's advertising includes logos of some well-known companies. So this is typically individual investors looking to buy shares in companies they feel connected to. At the same time as we're coming off the back end of 10 years of growing in passives, low-cost solutions which allow investors who perhaps don't have access to that information to track the market and do well for themselves in that way. So I think we've got a few minutes left, and I'd just love to hear some thoughts about how that dichotomy between passive and individual stock selection works, or maybe rather like myself, if you end up doing both.
I think for free trade, it's how do we educate people to make that choice. I don't want to sound like a broken record, but we see passives as really important. It's a really good way for people to get into investing and to diversify naturally their exposure. So we think it forms a core part of a well-balanced portfolio. Whether that means that that's in place of investing into individual companies, I think depends on the person, their circumstances, their level of confidence and knowledge, willingness to do the research, and again, how much the data is available to them. I think the challenge with the data being available is often, how do we make it available in a way that the ordinary investor that isn't a professional can understand and relate to, and having context with say other companies in the same industry, and help them make better informed choices. So I think we will always see a blend. We definitely see that there are people that will invest in the things they know. There is some merit in recognizing that the brands that you know and you understand them well. You kind of get that leg up, if you like, into understanding why a company might be, or even just a personal interest into digging into, say, I don't know, the latest results of a Tesla or of an Apple or Alphabet, something like that. Really, they're brands you know every day, so you go a little bit further to understanding a bit more about what they are doing, what the news is saying about them, what people are saying about their prospects going forward. So that familiarity does help people get a little bit more into the nuts and bolts of investing, but it is always, I think, balanced with more diversification.
Yeah, that makes sense. Tara, highly branded consumer investing. This is something you're an expert in.
Well, look, I think the fact that retail investors there's this wall of retail money that is coming into capital markets is an undoubted fact. Not just in the UK, in the continent. I kind of refer to this sort of Americanization of retirement. the US started, right, with tax advantages on your 401k and your Roth IRA. Then the UK has done something similar with SIPs and ISAs. You haven't actually seen that kind of equity, that promotion of equity investments on the continent, but you will, because it's inevitable, because of all the reasons that we know, low interest rates environments, difficulty accessing housing, the governments can't support people's retirements because people are living longer. So the burden and the risk is being pushed back onto retail investors, and so this whole generation of savers is becoming investors, and they want tools like primary bid, like free trade, because they're used to, as you said, they're used to consumer engagement that works and apps that are beautiful in all other aspects of their life, and they're just not going to put up with what they've had in the past. So watch this space.
Wise words. I hope they come true for our sake and for free trade's sake. Andrew, Jason, I'm not sure either of you will be allowed to invest in single stocks given your respective seats, but if any closing thoughts before I close the panel?
Yeah, so we're not unfortunately allowed to invest in single stocks. That pleasure was taken away from us a few years ago for probably for good reason, to be fair. But yeah, look, I think the market that I look at is probably the Australian market, where it's the most, this kind of retail shareholder movement is probably most developed because of what happened with pension rules and the superannuation rules that were put in place there. And I lived there for about 6 months, and everybody had a view on stocks and shares. Everybody was an investor, but actually that felt to me incredibly healthy. It was, people were more educated, and it wasn't just punting. It was, people taking. I think it's somewhat of a myth that kind of retail investors always means that they're kind of just trying to flip for a price. A lot of them were kind of sensible, very sensible long-term investors. And I think, you see the UK going that way, partly pension freedoms, partly low interest rates and everything else. And I think, the world will travel in that direction, I'm sure.
Yeah, it's a really good point on holding periods. You're not, as an individual, you're not held to reporting your results every quarter. Your result may be in retirement. Jason, you started the panel, so you get to close.
Yeah, thanks. It's fascinating. I think this is probably one of those unique moments in time when, the technology on your iPhone as a private individual investor through something like a free trade or an eToro or whatever is quite remarkable. You can invest in single stocks. You can buy Amazon, Google, Rolls-Royce. You can invest in Bitcoin and run portfolio strategies based upon your own criteria. And to the point we made earlier, the underlying infrastructure behind all of that, behind the application and the phone needs to catch up a little bit. So the democratization of investing, and this isn't the first time this has happened. I'm slightly older than the rest of the panel perhaps, but I remember Big Bang and deregulation, and all of a sudden we're launching e-brokerage firms and telephone service centers to take order flow from retail. What you have on your iPhone these days is quite remarkable, and I think that's just a case point where we are right now in terms of technology and the application of that technology. And I think the world of fintech is powering a fantastic transformation. So the whole capital markets ecosystems certainly investing in that and partnering through these fintechs to make sure we're able to keep pace.
Well, very exciting and great to be part of it. All that leaves me with is to thank our panelists, Jason, Duncan, Tara, and Andrew for being on this panel, and to UK FinTech Week for letting us organise it. Thanks very much. Have a great week.